the readiness or the sophistication of the investors. To me, the right term is not necessarily sophistication, but the expectation. When we talk about the displaced commercial risk, it's basically defined in a very colloquial manner, that is the risk of depositors running away when the rates fluctuate and so on. Here I think we have to look, because it is a behavior question, we have to look at this perspective from the behavioral context of the investors or the customers. You have the corporate investors and you also have the retail investors. Look at how these two investors actually behave. For corporate investors, or from a conventional term, depositors if you will, what we observe from the data that we have is that corporate investors are very sensitive to the movement of the profit rate. So if the profit rates are actually much less than the conventional counterpart, then they might actually move their investments around. Retail investors, on the other hand, I'm not too sure, and the reason that I say I'm not too sure is that we simply don't have enough data for that. We don't know that if the profit sharing rate actually reduced from 2% to 1.5%, would it actually cause a run in the entire banking system? Therefore, to conclude my point of view, I think we need to have a very specific analysis, a very specific data, to actually imagine and conclude that if the banking system goes into that model, what will happen to our industry? And just to finish it off with one scenario, let's say if we try to imagine the future where the Islamic banks actually go on this model, how would the market, how would the dynamics behave? I think I have quite an interesting theory about this, because if we imagine that from now on, all mudarabah investment or deposit account is dependent on how much profit the banks actually make, and let's say all Islamic banks do this, I think the repercussion is that the banks, which historically has a good record of profits, would probably have an advantage to those banks which have losses or low records of profit. Because as a retail customer, if somebody is to say to me that, Nick, you can put this deposit or this profit sharing investment account with me, but if I lose money, you lose money, obviously I will take my money and put it into the strongest bank in the country. So I thought that is quite an interesting dynamic that we have to consider. Thank you.
Kenneth, do you have anything to say?
Good afternoon, everyone. I guess on that point, I agree essentially with what Nick is saying. I think, though, we can get too caught up in form, and it's probably advisable to step back and say, who are the customers? What are their expectations? And how educated are they about the products that are on offer? I think the investment product and the deposit product are different, and investors go in with one expectation, depositor goes in with another expectation, and we just need to be able to address both those expectations in order for the Islamic finance market to continue to grow. So that's my thought on that.
Okay. Thank you. I think it was a very good viewpoint set. If you're looking from the perspective of a bank practitioner, a banker, the argument on what the customer wants, actually that is really important from the perspective that the bank has to maintain a certain regulatory requirement, capital ratios and deposit ratios. So in circumstances where this is put forth to the customer on choosing an account where your investment, at least your principal is guaranteed, and an option where your principal is not guaranteed, where you could get extremely high returns or you would need to forgo your principal, I think, which is the argument currently with the Islamic banking industry, is that something that the Malaysian customers are used to? Would it be something that people can accept and absorb? And going further or elaborating a little bit on that issue, the current environment in Malaysia right now is that PIDM, or the Malaysian Depository Insurance Corporation, guarantees a certain amount of principal of the deposits. Now, in a situation where the Mudarabah deposits are considered investment deposits rather than deposit accounts, it's also a question on whether PIDM would still want to guarantee the deposits. So in that circumstances, you're actually looking at a scenario where a customer comes to the bank and is aware that it may not be guaranteed by the PIDM, and it's also a situation that the bank doesn't guarantee their principal at all. Dr. Engku, from the regulator's perspective on the guarantee by a third party on a Mudarabah contract, what would you say?
My understanding of this issue of Mudarabah investment account being reclassified as an investment instrument rather than a deposit instrument is that it does not negate the bank from taking steps to as much as possible protect and safeguard the investment of their investment account holders. I think it is common practice by a number or many Islamic banks to have reserve, and they have been practicing profit equalization reserve, and this in a way has helped the Islamic bank all the while to smoothen the payments of their profits to their investors or to their investment account holders. Although there has not been a clear indication by PIDM whether they are willing to guarantee the capital of the investment account holders, it is still under discussion, and hopefully we'll end up with PIDM agreeing to guarantee the deposit, even though it is under the investment account, because from the Shariah perspective, there is no impediment for a third party to actually guarantee the Mudarabah capital. The only impediment is for the bank itself as the Moderator to give the guarantee. So we can still have the third party guarantee. If not, from the IDM, which I hope they would, but if not from the IDM, then perhaps it can be arranged with other mechanisms. I don't know whether there would be a takaful arrangement or something of that nature that would be able to sort of be arranged by Association of Islamic Banks, for example, to cater for that need. But as of now, I think we are still putting our hope on PIDM.
Another issue, perhaps more on the operational risk. The current structure on Islamic financing, the complexities within the structure itself, and the need to conform to specific requirements of the akad, the sale and purchase agreement, both at the point of the origination of the contract as well as at the point of restructuring. The need to ensure that at every point in time the structures are in order, could that possibly lead to additional operational risk for Islamic banking as compared to conventional banking?
Thank you. I think the answer is yes, that Islamic banks, given the same level of operation or size or compared with the entity bank, and given the same business strategy, and let's say that strategy is providing home financing or car or personal financing, that an Islamic bank would be exposed to more operational risk than a conventional bank. That is my personal point of view. And the reason why I say that is because Islamic banks are exposed to Sharia non-compliance risk, where conventional banks don't. Conventional banks don't really care if the sequence of transaction between asset purchase and asset sales agreement are done correctly, They don't really care if the account is in default, and if you have to do recovery, that you have to terminate the old agreements and do a new one. And then they don't really care if when they give a home or personal financing, that it has to be referenced to a tangible asset which can be identified. You know, conventional banks are not in the business of doing that, but Islamic banks are. So because of that, by definition, Islamic banks are exposed to more Shariah non-compliance risk or operational risk as compared to conventional bank. For the sake of clarity, there are lots of definition what Shariah risk is. And perhaps I can joke with some of you. I've asked this question to many people in many conferences. Some people say Shariah risk is the risk of having the legal agreements wrong. Some people say that Shariah risk is the risk of charging interest. Some people even say that Shariah risk is actually the risk of going to hell. Which is, actually, when you think about it, it's not exactly wrong. But we have to define what is the definition that we want to choose. And the Islamic Financial Services Board came up with a definition that says Shariah risk is a type of operational risk. It is a risk where the bank or the financial institution breaks some Shariah rules or resolution, and as a result of that, loses money, loses reputation, or gets its license taken away. So, you know, to conclude, yes, that there is more operational risk for an Islamic bank. However, it doesn't mean that an Islamic bank is not economically competitive. As in with any risk, those risks can be managed and be contained with good governance framework, with good Shariah risk management framework, and even turn into a strong competitive advantage. So, yes, I say that there is more risk for an Islamic bank, but on the other hand, I also say that the business case is also very strong.
Yes, Kenneth?
I would just like to add again that the Sharia risk does come up in the context of conventional banks. A lot of conventional banks are marketing Islamic products, Sukuk, for example, Rabiah, so on and so forth. I mean, there is Sharia risk associated with the conventional banks as well, although albeit to a lesser extent. But certainly none of the conventional banks wants to be in a situation where they've sold products that are purported to be in compliance with Sharia and end up not being in compliance. So it's a bit of a broader area rather than just applicable to Sharia banks, Islamic banks.
With respect to Sharia compliance risk, at one level we're talking in the theoretical and the jurisprudential. Can we bring it down to actual examples where a bank basically was faced with a Sharia risk and what it did? I've worked with scholars, including Dr. Bakr, over the years, and one of the issues is Sharia, as we interpret it, it's not infallible. There are things that we haven't thought about in this niche market which is emerging, which is exposed to market risks that we don't have control over. Now, if we're basically saying that what we have is basically ordained and signed off by God, then that's incorrect. Therefore, the better way to manage expectations of a client is to say, pitfalls will happen, but here is the opportunity and the time frame to fix it. And I'll use an example from my days on the asset management indexes. If you have a company that's Sharia compliant, you have a review on a quarterly basis, and that company is no longer compliant. But the fund manager, for whatever reason, hasn't deleted that company from their portfolio. There are safety fail mechanisms that are built in, that have been signed off by scholars saying whatever capital appreciation that took place from the time it became non-compliant to the time you sold it, you have to basically calculate and disperse to charity. Right? So that there's a mechanism to fix it which doesn't taint everything. And I think that's the biggest issue for us, that we have Sharia non-compliant risk. That means everything else is tainted, and therefore everything else is haram, and therefore we're going to this systemic risk. To prevent that, we need to manage expectations of the client to say, issues will arise, here is the pathway to fix it, and here's how the monies that are earned by the bank will be allocated, and you will not be penalized.
If I can add a little bit of my view on this, before I go specifically on the issue of whether Islamic finance have more operational risk than conventional, firstly I would like to just express my view that to me, conventional banking has their own risk or specific risk. Islamic finance have their own unique risk. There are some risks in the conventional space which is not a problem in the Islamic space. For example, we have seen the subprime crisis and the credit crunch. That kind of risk perhaps may not be present in an Islamic financial system. But having said so, when you're talking specifically on operational risk, and you specifically focus on the issue of Shariah non-compliance, that of course this will not be in the radar of conventional bank, because they are not expected to be Shariah compliant, so they don't have any risk of not being compliant with the Shariah. So for the Islamic banks, yes, they have this risk that their operations may end up not being in compliance with the Shariah, and therefore, as a result of that, they can be further exposed to additional risks, such as, first, when it is non-Shariah compliant, okay, Nick interestingly say that there's the risk of hell, okay, so there's a religious accountability there. And secondly, in some countries like Malaysia, which requires that Islamic financial institutions must be Sharia compliant in the law, so the fact that they are not Sharia compliant may be a legal risk as well, where they can risk the contracts that they are entered into be declared by the court in the country as null and void. As we have seen, we have precedents in the case law in Malaysia, although later it was reversed. The High Court in Malaysia declared an Islamic banking transaction as null and void based on what he perceived as non-compliance with the Sharia. So the Sharia non-compliance can give rise to legal risk. And in addition to that, even if, say, the non-compliance happened and it is not declared by null and void by the court because it's not defined under the law. For example, if you go to the English court, they will not look at whether it's compliant or not. They just look at the contract. They may still declare the contract as valid. But at the end of the day, when Islamic bank goes to their Sharia board, when they declare their income, the Sharia board will not allow for the non-compliant income to be recognized. So they have again a risk of lost income. Okay, and not to add on reputational risk, which they has alluded to. So there would be a risk on the reputation of the Islamic bank if their customers claim to know that the Islamic bank actually is doing non-compliant businesses. So those are some of the things that I want to share.
Actually, following up on that matter, right? There would be circumstances where in some organizations or in certain banks where a structure is done or a process is put out in place, and the Sharia Council or the Sharia Advisory Panel does endorse the process and the operations. However, when the product actually goes out to market and it's bought by customers, there could be circumstances where a customer comes to the bank and says, I don't think that your product is Sharia compliant or your processes were right. As in the manner in which you do the akad or any one of the structure during the transaction itself. Now, how would the bank be protected in terms of any legal risk from that aspect? And also Sharia or reputational risk to the bank, where there are differences of Sharia opinions on the matter. good. Kenneth, help us out. If Ellen and Overy has had any examples or any...
Yeah, it's a subject that comes up frequently on the capital market side. People are issuing sukuk. They're marketed as securities to investors. And our clients, which tend to be either the issuer or the bank, the arranging bank, always have a concern. What would the impact be if the investment was found by somebody to be non-compliant with Shariah at some point? It's a risk that everyone takes. I think from a disclosure perspective, we always ensure that the offer documents disclose the fact that there's a fatwa covering the instrument, but there's never any covenant by either the banks or the issuer that the instrument is Sharia compliant or will remain Sharia compliant. So I mean, the investor takes the fatwa for what it says. They review it and they can live with it or not. If somebody else later finds that they disagree with the fatwa, I think we try to minimize the risk on an issuer and the bank through the disclosure process. We always insist on not having covenants that things will remain Sharia compliant, because views change and people adopt different views from time to time and challenge some of the fatwas.
Okay, I think the question on how the stakeholders or the Sharia committee or the board can get assurance that the processes are in line with Sharia principles. The answer is they can have that assurance by having a strong, robust Sharia governance framework, Sharia risk, and Sharia audit. The thing about risk and audit is the output, the end result of those risk and audit would only depend on the quality of the information that gets escalated to the stakeholders, not necessarily the process itself. Now, the penalty for Sharia non-compliance, at least in Malaysia, is very severe because of Islamic Financial Services Act. Perhaps Doctor can help me in terms of details of it, but the last time I read about it, it talks about imprisonment and it talks about financial penalty in the range of $1 million ringgit, so it's very heavy. Now, so if we analyze the question, why was there instances when a product was properly approved by a certain committee and later in the end they found out that the product was not Sharia compliant and has to be withdrawn and so on? The question that I would pose is, what was the quality of considerations raised during that product approval process? Was it limited to only the legal agreement, the product structure, or does it go all the way to the standard operating procedures on how those products are going to be rolled out? Because the thing about Sharia non-compliance risk is, as more and more Sharia audits that we perform, that we conduct, my firm in PwC, we conduct Sharia audits for a number of banks, and what we understand is the Sharia non-compliance risk is actually wider than at least what the industry typically think. Legal agreements and products are definitely the key component of it, but if you look at the entire value chain of Islamic financing, you would have the marketing material. Has the right representation been made in that marketing material when you market those products to your customers, right? When you give product approval and when you extend that facility, do you actually vet the nature of the borrower in terms of whether the business activities are Sharia compliant or not? When you look at operations and legal agreement, has the board or the stakeholders actually got assurance that the sequencing of transactions been done in the correct manner? When we look at recovery, whenever you have a Rabiah contract and when the sales price actually breached, the ceiling price. Has that contract been terminated and replaced with a new one? And many other examples, which the question is whether these considerations, whether have they been discussed in detail at the product approval committee level? Because if the answer is yes, then there should be no strong reason why these events would happen after the approval phase. However, if the answer of that is no, it hasn't been comprehensive enough, the considerations have been complete, then of course the risk of the product being discovered to be as Shariah non-compliant will be higher, even though the product has been legally vetted.
I think the question is a bit general, and I think the issue is whether this agreement on whether this product is truly Shariah compliant or not may happen prior to the contract being signed, and it can also happen after or post the contract being signed, because we are talking about the Shariah committee of the bank is already approved, and then when it goes to the customer's Shariah advisor seems to feel that it is not Shariah compliant. So that means they have not yet signed or come to a contract. So this is still at negotiation stage, and it is common for Shariah committees to have different opinions on certain products. So normally when this happens, if they want to proceed with the transaction, they would normally restructure the instruments such that the new structure would be satisfactory to both the Shariah committee of the bank and the counterparty. And then when both have already agreed, then only they can come to a contract, mutual contract between them. So if one bank says it's compliant, the other bank says it's not, I don't think they will enter into that contract. The deal will not be pitched. So the other issue is, let's say they have already done that and both parties agree that it is Shariah compliant. It's only after the contract one of the parties try to argue that this is not Shariah compliant, then that can be something which perhaps I can quote one judge in Malaysia who said that the customer had gone to the bank, entered into the contract, enjoyed the benefit of the contract, and suddenly turn around and say that the contract is not Shariah compliant and I don't have to pay my obligations to the bank. So this, according to the judge, lacks bona fide, because both of you have agreed, both of your Shariah courts have signed off the document saying that it's Shariah compliant, and then suddenly after that we turn around and say that we feel it's not Shariah compliant just to avoid your obligations, then it is not bona fide and it should not be entertained, because you are bound by what you have already agreed earlier. And there's also another issue. Let's say there's a change of fatwa. Like initially we have seen in the sukuk market there's this purchase undertaking being practiced. And then in 2008 we see the AOF Shariah Board giving a new pronouncement prohibiting purchase undertaking. So even if this were to happen, then it will not have a retrospective effect. So that means the previous fatwa will stand for the previous contracts. That fatwa will only affect the future contracts. Okay, so I think that the fear is because sometimes people don't really understand how differences of opinion happens and how to go with the differences of opinion without hurting or limiting or without doing any injustice to other parties. Now, another thing that I want to comment on is the thing which Nick has highlighted, the issue of when there has been actually a due process on the approval of the product, and then suddenly we found at the end that the product does not comply with the terms of the approval. This is what normally happens, because sometimes when it goes to the Shariah committee, the description of the product is A to D, but when the product is being launched and being marketed, it has extended some of the features beyond what has been approved by the Shariah committee, although the structure may remain the same, but the specific features added to the product may lead to issues of non-compliance. So this is where Shariah governance will come into play, because non-compliance can happen, one, because of I do not fully implement what their Shariah committee have decided, or they implement but they add further without referring back. So they have to, because they have secretariat inside, the secretariat should be able to identify whether that addition has a Shariah issue or it is just a normal addition. So these are some of the things that I will try. And the other one is sometimes when the product is being brought to the Shariah committee, essential technical aspects of the product has not been fully disclosed. And this non-disclosure may be inadvertent or perhaps maybe also deliberate, which I hope is not the case. So without enough technical information, sometimes the ruling by the Shariah Council may not be that accurate. So we need better governance procedure to make sure that all disclosures are in place and that perhaps the best thing is a simulation of the product we made before the Shariah committee so that they can see how the product works from the beginning to the end before they can really see how whether it's going to be allowed or not.
Thank you. Yes.
A few comments. The first is because sometimes time lapses between Sharia board meetings, what we've seen the last several years is the introduction of a Sharia liaison officer who basically acts as the eyes and ears of Sharia adherence reports. So that's one level of addressing the leakage, quote unquote. Second is the reputation of the scholars. I mean, a number of studies have come out that X number of scholars sit on X number of boards. This is their livelihood. So at one level, they're going to protect their interests. Now, I just have to digress and talk about the role of lawyers. Today, Islamic finance is measured in pounds, not pages anymore. That's how big the documentation are. And these scholars sit on a large number of boards. So what we're seeing now is scholars working closely with lawyers in the sign-off of the products. Frankly speaking, it's just difficult for me to foresee a scholar sitting on 80 boards going through a 1,000-page documentation for an information memorandum. The last point I want to add is trying to bring some element of realism is if we look at the investment DAR and Bloomberg scenario, that's actually when we had the intervention of Sharia scholars pushing back the institution that pays them. You know, when the bank basically said that this contract is non-compliant and therefore we do not have to pay, the scholars intervened and said, no, the contract was indeed compliant and you do have to pay. So now you're seeing the voice coming not so much from the client depositor moving away with their money, but the scholars themselves intervening. And that's good.
That's good. Thank you. Very quickly before I open up questions to the floor, in the last session there was a question which actually relates to concentration risk. We see a lot of Islamic banks' assets are concentrated on the property market area, and typically property market means it's a long-term financing. And these long-term financing assets are actually funded by short-term deposits. Given that there is, even till today, there is a lack of acceptable Islamic money market instruments in the market, do you see that as a constraint for Islamic banking, or there's a risk for Islamic banking going into such transactions? Rushdi, maybe you want to help us with that?
At one level, Islamic banks basically are an amana, a trust for depositor money. So at one level, they're going to do what works for them, real estate exposure. Whether it's commercial or residential, that's what they know and that's what they're good at. Unfortunately, we don't have enough quote-unquote derivatives to offset some of that risk for some Sharia issues, and so on and so forth. So a concentration risk with respect to exposure to the real estate is one of the challenges that needs to be addressed. the key issue is what other areas can Islamic banks diversify into that has the risk element of real estate? Is it stock loans? I don't know. This is something that actually scholars have to start working with practitioners at the earliest stage of product development for you to start thinking about the diversification of this particular risk.
When we talk about concentration, then we have to differentiate between whether we are talking about concentration in terms of the instrument used, or we are talking about concentration in terms of the asset class or the specific industry that the Islamic bank are actually involved in. Because when you're talking about, let's say, concentration in the instruments, I think that would be perhaps not really reflective of the real thing, because the real thing is actually where the bank actually puts their money in. They can use instruments like, they can use instruments like Rabiah, they can use instruments like Negara, but the fact that it's linked to a specific industry, because I think that the main concern is like when we have the economic downturn in the Middle East. I remember one of the main issues was because of the over-concentration in the real estate industry. So when the real estate industry sort of not really collapsed, it's actually slowed down, and it caused a slowdown on the various sectors, in the, particularly also the financial sector. But if the bank's resources actually is adequately diversified, then I think the issue of over-concentration on certain sectors may not happen. And I think this would be more in line with we're talking about the objectives of the Sharia, maqasid Sharia in Islam. We look at trying to make resources available to the widest possible segments of the society, and then we need to also distribute these resources in accordance with the priorities, like what is really needed by people. Let's say food production, let's say basic needs. So these sectors are actually the sectors that will always have demands. But when we talk about over-concentration on certain sectors, which is perhaps under the tahsiniyat or things which complements life, it will not be inconsistent demand. It will be demanded when life is good, but it will not be in demand anymore when life gets more tight. So if we really follow the guides under the levels, how to make parity in the use of resources, we can actually carefully plan how the excess liquidity can be actually waterfalled down to the widest possible segments, especially to those who really need those excess liquidity in the society.
Thank you, Professor. Nick or Kenneth, would you like to respond?
Okay, thank you very much. On the issue of concentration risk, I'm going to tackle and analyze the issue from two perspectives, from the banking perspective and also from the corporate perspective. From the banking perspective, yes, banks sometimes expose themselves to too much concentration risk, but in my opinion, it is not by the virtue of their Islamic, because we can observe any bank, be it Islamic or conventionals, are exposed in one way or another some type of concentration risk. Some banks, be it conventional or Islamic, sometimes have too much portfolio in personal financing or personal loan. As a result, if the economy suffers from recession, a lot of people cannot pay and they suffer. Some banks concentrate too much on mortgage products. Some banks concentrate on car financing, and some banks concentrate on corporate financing, too overly concentrated in certain industries, for example, construction, tourism, and so on. So when we talk about the issue of concentration, I see that as an inherent risk or issue in any banks, depending on the strategy and the competitive advantage which the bank takes. So my view is it's not necessarily distinguished by the fact whether they are Islamic or conventional. My second point is more interesting, and I'm actually quite hesitant whether I should raise this point or not, because I wonder whether it would get me in trouble. It's more from a macroeconomic perspective, the concentration with regards in Islamic finance. If you look at quite a lot of the companies, large companies in Malaysia, they have as part of their investment mandate an inclination to invest their funds in Islamic instruments, right? We're not talking banks, we're talking construction companies, government-linked companies, and so on. Now, what happens when, and that helps to explain why, like Rafi mentioned just now, earlier today, that whenever there is an Islamic sukuk, good quality sukuk issuance, that you always get oversubscription, because the demand for Islamic papers are very high, and the reason why the demand for those papers are very high is partly influenced by the credit risk considerations, the rating, and also secondly by the fact that the investment mandate are very skewed in this country towards Islamic finance. Now, so that's Malaysia. But if you start looking at your investment portfolio outside of Malaysia, let's say you have a large fund, and you say that outside of Malaysia, I can only invest in Islamic instruments. If you look at the entire geographical dynamic, in the world, there are not that many countries that issue sukuk. Malaysia and Middle East, United States, Europe, Australia, UK, Japan, none or not many. So my concern is inadvertently that by there is a rule of unintended effect of this, because the fact that some companies have heavy inclination towards Islamic instruments, that they might be inadvertently exposed to Middle Eastern exposure, right? As opposed to diversifying away. So I'm not saying that it is a good or bad policy. All I'm saying is for that kind of companies that has huge concentration in the Middle East, by the fact that they have to only invest in Islamic instruments, if the Middle East suffers from economic recession, then those companies or organizations that holds a lot of these papers would suffer as well. So that's just my opinion.
Okay, at this point, perhaps I'd like to open the floor for any questions that you have to our list of panelists here. Okay. Sorry, there's a question there?
Assalamualaikum, Iqbal from Canada. Just a simple question. From my experience to set up Islamic banking window at my organization, we face a challenge to find subject matter expert on Shariah risk management. So not many experts out there, I think. Maybe the panel speakers here will be one of my candidates to train my personnel after this. Okay, my question is that from the speaker's recommendation, is there any software or solution out there provided by any IT company that can assist in managing the Sharia risk in Islamic financial institution? That's one question. Question number two is, which is the best as a solution to manage the risk? To train the existing conventional risk management personnel to understand Sharia risk, or to train the Sharia qualified officer to understand risk management? Which one is the better solution? Thank you.
Thank you. Would anyone like to take that?
So there are two parts of the question: system, or which personnel is better, really, conventional people trained in conventional risk management, or people who are trained in Islamic finance. And about the system, Personally, I do have some reservation about over-relying on the power of the system to manage Sharia non-compliance risk. Because in my view, to manage Sharia risk is actually very, very simple. It doesn't actually doesn't need to involve a multi-million computer system. The most important part of managing Sharia non-compliance risk is the ability to define and identify what are those risks. In terms of build, for your organization, build a list of 20 possible operational events that can result in Shariah non-compliance risk. The thing about a system which deals with risk management, that typically the methodology are quite widespread within the operational risk management world. You have risk control self-assessments, you have key risk indicators, you have loss event database, and what this system does is automate these processes so that you have those reports in a quick and in a complete manner. But the effectiveness of those reports and the action behind those reports is only as good as how good the organization or the team is in identifying those Shariah non-compliance risks. So that's number one. So my point of view is it's not the system, it is the quality of information that you put into the framework. Point number two, whether which group of people is better, conventional people or Islamic people, my answer is people who can understand Shariah risk, regardless of where they come from. Because any person who can understand in finer detail what is Shariah non-compliance risk, where can Shariah risk appear within this set processes, and bear in mind different banks and different taxable companies have different processes. The person who can appreciate that particular information is the right person to manage Shariah non-compliance, Shariah team, regardless of whichever background they come from, even accountants. Thank you.
Thank you. Yes, Rushdi, please.
In terms of trying to understand the Sharia risk for an IFI, the best one can do, at least from the optic that I come from, is look at proxies. Okay? So if it's publicly listed, what is its stock price and how has it reacted to certain situations? Investors invest with their feet. Again, it's a weak proxy, but nonetheless, it's one aspect. Second is the ratings, right? Yes, the rating is to the underlying institution, underlying instrument, but that instrument is also linked to an institution. The third is basically, you've got surveys that come out from, I don't want to name organizations, but they rate the best safe banks. And these ratings came out after the credit crisis 1. And there was, I think, 1 or 2 Islamic banks mentioned in it. You're not going to have an exact answer for a Sharia risk, but you need to think about proxies that look at the Sharia risk of an institution, and it's putting the pieces of the puzzle together, and you have to figure that out. Again, we're emerging, so we're looking at a paradigm that requires outside of the thinking of the box at this stage.
Thank you. We have time for another question, if there is one. Yes, please. Can someone pass the mic down in the hallway?
Thank you very much. Of course, we all know that there are common risks that are applicable in case of conventional finance as well as Islamic finance. I have just a single question. What are the risks that are only in Islamic finance? What are the risks that characterize Islamic finance? Thank you.
Your question was, what are the risks that are specific for Islamic finance as compared to risks which are general?
Okay, the answer is there are 26 risks. Sorry, I'm just kidding. There is no specific list of definition or number. It depends on the activities of the Islamic institution. Because if Islamic banks, some type of companies operate quite differently from another. But what we have to appreciate is this Islamic risk. Okay, if we talk about risk, typically in a syllabus of risk management, the accepted convention is there is a market risk, credit risk, and operational risk, and to a certain extent, strategic or reputational risk. Market and credit risk are shared, in my opinion, by both Islamic financial institutions and also conventional. So they are common to both of them. If we forget about the form of it. Operational risk, both conventional and Islamic institutions also are exposed to it. However, within the ambit of operational risk, the Islamic institutions are exposed to a bit more. And those more will depend on Sharia-sensitive processes. And the reason I say Sharia-sensitive processes is because not all processes in a bank are Sharia-sensitive. For example, if we talk about a settlement of a fund, rentas and so on, where you have to get two counterparties and authorize and then approve it, in my opinion, there is no sensitivity about Sharia issues within those processes. But if we talk about legal agreements, how the legal agreements should be sequenced, the kind of asset that back that transaction, the quality of information that you put in your material, whether you're communicating the right issues or not, those are the risks which are specific to Islamic financial institutions. So my answer to you to conclude is, there is no specific list. It's very different depending on one organization to the other. But what we can observe is those risks are Sharia sensitive in nature, where the conventional bank, yes, plainly speak, don't really care about, but Islamic banks do because of the Sharia rules.
Would it be right then, Nick, to say that the difference would be Sharia risk, which is inherent in Islamic banking but not in conventional? However, Sharia risk actually extends itself to all the other areas of risk, which includes operational, market, reputational, and everywhere, credit risk. Wherever there's an element of Sharia, that would be the Sharia risk in those aspects as well.
That is a fantastic observation, Juan. From what we observe is, I think from the base, if we study what is Sharia risk, it is a type of operational risk. However, it can transform into other type of risk, for example, credit and market risk. I mean, for example, the issue about, if you go back a few years back, the DID and Bloom Bank, where one of the counterparty, simply speaking, used Sharia as an excuse not to pay back the amount. So that is by using Sharia non-compliance as an excuse. So that was one of the observations where we noticed that Sharia non-compliance risk can morph into a credit risk. And in fact, closer to home, in our country as well, one Sharia scholar shared with me that right now, if you go to the High Court, you can observe more than 1,000 cases where borrowers are using Sharia non-compliance as an excuse not to pay back their loan, which is completely, unethical, but I'm saying it is a real risk. A market risk, back in 2007, when Sheikh